with the types of data, focusing on time series analysis. In a brief, I'll give a look at all the data so that you can make it out how time series stands. Then what is time series analysis? Components of the time series analysis, methods of time series analysis, the various techniques we use, what are the available software we can use, as well as the out of the various techniques. Here in today's session, I'm going to deal with IPREMS approach to the time series analysis and some hands-on session. I don't know how much time the organizer will provide, but what I have done is I have analyzed some data, brought with the pictures and all. Still, I'm going to open the reviews and do if time permits. So coming to the type of data, we are very much acquainted with this classification where one side we have the categorical data or qualitative data, and other side is the numerical or quantitative data. Coming to categorical data, qualitative data, it is again of two types. One is the nominal one, where you number the different units of different into different categories, like for example based on gender, marital status, educational group and all. So in this it is non-numeric. Even if number is there, it is something which is not subject to any mathematical operations. Okay, for example, suppose you assign first male 1 and female 2, it does not mean female is second class or female is twice than the male. So this does not have any numeric sense. Ordinal data is something of order. For example, when you are different ranks, grades, anyhow, this is categorical data. Coming to numeric data which is quantitative. Again, it can be your discrete data and continuous data. Discrete is something which is not in a series. Okay, so for example, different number of students in a class, population of a city, village, these are all discrete one. But some data are continuous. Okay, so like for example, your temperature, height, weight. So these are thing which takes all the in between numbers it passes through. It's a continuous data. Coming to the type of data we are dealing with, obviously it is numeric, quantitative. Now these are mainly economic and econometrics data which we use to get a number of information from them. So based on this, we have broadly these three groups. Again, another one is the pooled cross-section will come upon. Now first, the three broad classes are cross-section data. Then we have the time series data, and a combination of both these is the panel data. So out of cross-section, again we have the pooled cross-section data. So let us have a look about all this data and where time series stands, how it is different from the other one. So coming to the cross-section data, you can see on the screen. In this case, what you do is there are a number of entities on which you collect the data. This may be person, any individual's unit, or maybe companies and all. So in this case, particular table you can see it's a table on different persons, and the various variables you have collected data on is the income, gender, age, then marital status, education and all. So in this case, you can see there is no work of time element. Time does not have any significance here. So this is for a particular period of time. So time has no significance here. So how you find, for example, suppose here Y is the income, and you want to find how income of a person is determined by the other variable. So what you do is simply regression you use, where your Y, for example, say this is the income is a function of these other variables. Your X, maybe gender, you can expand the independent variables. Your age, marital status, where obviously if it is gender, you know, we use dummy variables, binary, your 0 for say male, female, 1 for male, and whatever, 1, 2 also you can use. So we handle it like this. Okay, so this is a case of cross-section data where time does not have any significance. Now this is an example of a derivation from the cross-section data where you have the same information. You can see I've shown you the same table, but over two different time periods. So for example, you can see in 2020 the data was collected about this individual units over your income, gender, age and all. Again in 2023, the data about all these variables were collected. Okay, so in this type of data, what is important is you can make a comparison. And one thing very, I want to point out that these units 1, 2, 3 in your table 1, 2020 and 23 need not be same. you can choose the same area. For example, you want to calculate all these variables before and after a policy change. In 2020, what was the situation? Maybe you know it's 2020 was a COVID year. So 2020, what was the situation, and 23, what is the situation? The individual units need not be same. So if any policy changes are there, or after COVID, what is the scenario? You can compare it with pooled cross-section data. Here you can see time is there, but in discrete form over 2 different time periods you have chosen. But now time series stands out aloof, different from them. You can see time series is your data about different variables of a series of time period. In this case, for example, year, it can be monthly, quarterly, anything. Your hourly data also, stock markets, we analyze with your hourly data, daily data and all. So the data have to be over an equal consecutive period of time. As you can see in this table, I have the year, the data on log of foreign direct investment, GDP at the current price, then this is VOT is your volume of trade. So we have these different variables on which we have data, and obviously this time series data will be from secondary sources, while cross and cross pool section are primary service. This we can only calculate from different secondary sources. So you can see this is what is termed as the time series data. So when you look at these variables, the equation, you can compare it with the cross section equation. You see it's the same one. Only difference is, instead of the I element there, if you see in the previous one, there was an I element which stood for these different units. Okay, and this part does not have any significance of time. But in the time series data, it has been replaced by the T subscript, where T stands for the time. So it is over the different time period. So every subscript has a T time period. So this is a time series data. So I have written here only one independent variable. Obviously in the table there are so many independent variables. You can do a multiple regression analysis for this. Okay. So this is about time series data and panel data, where you combine both. So you have calculated the data about the different entities over different time period. Okay, so this is an example of a panel or longitudinal data, which is a combination of both your cross section and time series. But here important is your units should be same. If in the year, whatever units you have chosen, those units you cannot vary for a panel data, which you could do in a pooled cross-sectional data. Now let us focus on time series data. I have shown you how it is different from the other type of econometrics data we have. So coming to time series data, time series analysis, what we do in this is we analyze the time series data. So when I talk about analyzing the time series data, obviously what it means is we'll identify what is the pattern. Okay, so that whatever seasonality or your correlation, autocorrelation is there, we can remove them all, get a very white noise data, so that we can use the past data to predict what is going to happen in future. We can extend the data so that we can forecast about the future. So what is very important here is we are using the past data to forecast about the future. That's the time series element. Now, when I talk of time series data, what are the components we want to stabilize? So your time series data will have the following components, which are whatever the values you see for a time series data, say GDP data or a FDI data, it will have some trend, it will have some seasonality, outliers, maybe there are some values which are completely different from the others. Then your business cycles are there, your up and downs. Then all this taken together will check if the data is stationary or not. After removing all this, we will find a stationary data which can be used for further forecast. So let us see what they refer to. Coming to trend. Okay, so if you see the trend, it's better to take you to this picture. Now you see the trend element here. What you see in this graph, this is a graph I've taken from the net itself, the plot of a beer cell. What you can see here, the pattern of this demand is increasing over the years. So increasing over the years means it has a trend. Okay, so you can see the data going up, scattered plot is there, and the data going up, showing that there is an upward trend. Similarly, the trend can be straight one, trend can be downward. So, but some trend is there. That means the mean is not constant. So your mean, which is the average, is not constant. This is for a trend. So what you can, another thing you can mark here is, you see the data, it is increasing, again dipping down, next period. Again it is increasing, again dipping down, next period. So this is what we term as the seasonality, and they are equally spaced. They are equally spaced. So this is seasonality. And you can see the variance is constant because they are going up and down in the same way. So in this case, the variance and covariance is constant, but mean is changing. It's a non-stationary data. For a stationary data, your variance, mean and covariance should be constant. So in this case, as it is showing seasonality, variance are equally spaced, up and down movement is same. So what you about, so this is something which has to be removed, because if you take it focus with seasonality and trend, the focus will not be correct, because something which is vibrating, if you are using it to focus about the future, your focus will not come clear. So these are the elements we have to remove before we can use the time series data for further forecast. So you can see some examples of your time series, like your population, birth and death rate, your number of your industry or school in a particular area. These are all example of your time series long-term data. Now you see, this is another type of trend. You see, it's a straight one data. That means there is no trend in this time series data. This is a plot of the earthquake within a particular parameter from 7 to this for 99 years on 7 Richter scale for 99 years have been taken. So you can see there is up and down movement. The straight line which you see is the mean. So the data is hovering around the mean. So no trend is there. So mean can be taken as constant, but up and downs, your seasonality and other cyclical movement is there. Okay, so but no something which is outliers, we call some data which is completely different from the other, such thing is not there. So here we don't have your trend, you don't have your seasonality, some cyclical movement is there. So this cyclical movement is there. That means the data is still not stationary. Moving on, seasonal variation, which we saw with the diagram up and down. So seasonal variation means in some season the data may go up, go down. It may be for a number of reasons, which may be man-made, which may be your natural forces. For example, man-made reasons for seasonality in a data is, for example, say marriage season. Our purchase and sale, they pick up. We have in India, for example, particular seasons when a lot of marriages take place, maybe in February or at the end of December, something auspicious month. So the sale of some commodities pick up and then they dip down. Similarly, for example, your umbrellas or raincoats picking up during the rainy season, or for example, your summer season, some commodities pick up and other season they pick down. So these are something which is like your marriage and all is a man-made factor, and all these climatic changes are a natural factor. So this seasonality in the data may come out because of man-made and natural forces. Now, what about cyclical variation? Cyclical variation is a common cycle which goes on. For example, recently we had the COVID, when all the parameters, if you see your GDP was at, all the parameters were at a recessionary level. Your GDP was low, growth rate was not pulling up, per capita income started falling down. So this was a time when there was a recession going on. And gradually, again, we picked up. So these are business cycle, while your seasonality is within a year. Your movement within a year, your cyclical may surpass 1 year. So these are cyclical movement, which is up and down, but this also brings a variation to your mean and variance. So this also makes your data non-stationary. So your time series data consists of these three important elements, which is your seasonality, your cyclical movement, as well as your outliers. After removing them, stabilizing them, what is remaining is constant, your random or irregular movement, which is something which we call the error, which is because of some unforeseen consequences like sudden changes, flood, war, earthquake. So this may give some randomness to the data, but this has to, something which is apart from your seasonality and other cyclical movements. So these are some of the time series data you can see here. First data is showing a trend, but you see there is no seasonality here. Up and down variation is not there. In the second data, if you see B1, seasonality is there, up and down movement, but no trend, it is going straight. Third is an example of a cyclical movement. You can completely make the four components out now with these diagrams. This is a cyclical movement. You can see the variation is different from your seasonal movement. Seasonal movement is within a year, within a period of 12 months. But this may surpass 1 year because your recession to prosperity, it's not that every year or every month or every quarterly the recession and prosperity will be there. It may surpass the year. So, but it goes on. If there is a peak, trough will be there, fall will be there, and if there's a trough, up movement will be there. This is a cyclical common movement. So you have to remove all this randomness from this time series data so that it becomes clear for forecasting. And the last component after removing your trend, seasonality, and cyclical movement is the randomness, which is your error term. That means after you have taken all the factors into consideration, if any errors are there which you have omitted, that is included in your random factor. These are some other plots you can see over. This is a random movement. Trend is there. This is a cycle. It may not be so crafty like this. Your cyclical movement may be like this in this diagram. Okay, so this is a seasonal pattern. These are here. If you see the fourth diagram, it has both seasonality and trend. Seasonality is also there, trend is also there because it is also going up. So this is a pattern where your data. So depending upon what your data shows after you plot, you have to use the particular model in time series. So these are other plots. You can see it afterward. So what is important is after we identify all these component in the time series data, we have to model it out. That which model is we are going to use so that we are going to predict the values as a function of the other component and use it for our forecast. Now these are some examples of your time series data. For example, your weather related data is a time series data because it will vary over time. Similarly, your rainfall measurement, your quarterly sale of any products is an example of a time series data. Your stock prices, it is a time series data. Time is very important here in a stock market. Then automated stock trading, your industry focus, interest rate. These are all examples of your time series data. Now, what are the different techniques you can use to remove this component? So, all the techniques we use is how we are going to stabilize this trend, seasonality, and your cyclical movement, leaving the randomness only. Okay, so that the randomness become white noise. That means it is have a constant mean variance and covariance, which we can use for forecast. So, these are some of the techniques which is available, where we are going to use ARIMA, which is auto-regressive integrated moving average. So you can see moving average is one method. Okay, so similarly exponential smoothing is there, auto-regression is there, where you don't use any integration or moving average, only one variable using its past value to predict the future. Decomposition, where you remove this your seasonality and cyclical component, which is known as, you decompose and divide your data so that every season wise you can also predict. Then time series clustering, multivariate models, and other. So let us go to your ARIMA modeling. So about a step-to-step approach to ARIMA modeling, first what we do is we take the data and clean it. If any missing data is there and all, you have to clean the data because no gap should be there. It should be consecutive. That's the first one. Second, you have to visualize the data like I showed you in the plots. You have to visualize the data and see what your data exhibits. Trend is there or not, seasonality is there or not, cyclical fluctuation is there or not, any outliers is there or not. So that will determine whether your data is stationary or not. If it is non-stationary, we have to use methods to make your data stationary. Before we can model it out, depending on the stationarity of your data, you can use auto-regressive model, moving average model, ARMA model, which is a combination of your auto-regressive and moving average, or the ARIMA model, which is a combination of the all the other one, using making your data your stationary. Now, what is ARIMA? ARIMA is a very popular technique in a time series analysis because it has the capacity to capture both the auto-regressive component of a time series as well as the moving average component of the time series. Now, what does it mean? What do you mean by auto-regressive? Now, you see this. see this data. When you saw the cross-section equation I showed you, similarly the time series equation I showed you, where y was a dependent variable, x were some independent variable. Maybe income as a function of your gender and all in cross-section. Similarly, your FDP as a function of your GDP, market size, volume of trade. X elements are different, Y elements are different. Okay, that is something which is multivariate. Now you think of a data of a series where the current values are influenced by its own past values. This is what is known as autoregressive. So in this case, if you see the equation, why autoregressive means the dependent variable is yt and the independent variable on which you are regressing is also the past value of the same dependent variable. So you can see here your yt is the dependent variable. For example, suppose this is the foreign direct investment. Okay, so your foreign direct investment in the current year is dependent on some intercept terms, okay, along with your foreign direct investment 1 year back, that's why t minus 1, foreign direct investment 2 years back, we got years back. Similarly, your how many years back you can go, we'll detect it through our different tests. Okay, so you can see your P represent that lag period. How many years back you are using as independent variable to find how your dependent variable is depending on them. Okay, so that's why it is auto-regressive. So it is regressing on its own past values. So this is the essence of your auto-regressive model. Now I said time series data are by their nature your non-stationary. Your trend will be there, your other seasonality will be there. So we have to make the data stationary. When I say the data is stationary, you can see the graph here. This is the stationary data. Why? You see the mean is constant. The bold line in the middle is the mean, and mean is constant. The up and down variation, which represents it is moving up and down in the same oscillation. So this is your variance. Up and down movement is same, and from one to the other peak, you see the distance is same. That means this is the data which is exhibiting constant mean, constant variance, and constant covariance. And this is the type of data we have to use to forecast about the future. If you do it with non-stationary data, your forecast will not come clear. Okay, so this is the in the ARIMA, AR is the auto-regressive part I just explained. This is the AR part, which is auto-regressive. That means how many years back data you are using to find the influence on the current dependent variable, which is the same yt values. Coming to integration, it refers to if your data is not stationary, then you have to make it stationary, and the methods are you can use either, I just go a little forward to show, either you can make your data stationary by transforming, taking a log formation, or by differencing your data. This is what is termed as the integration part, the I part of your ARIMA model. So when it is non-stationary, you remember, first let me tell you what is differencing. Differencing means you are lagging the data by 1 year. Now you just see this data, the table on the board, you can see on the screen. This is the time series data from Jan, February, March, April, May, July, and these are the auto sales to CPI data is given here. Now suppose I plot and find that my auto sales data are not stationary. It has a trend or seasonality. I have to difference it first order, which means I simply, you can see I have plotted the table here. So I have copied the table and leaving the first place blank, I have pasted it from the second one. That means I have lagged it by 1 period. Okay, now if you subtract it, you see 1664 minus 1613, that gives you 0.51. This is the first order difference. You have lagged the data by 1 year or 1 time period. In this case, it is month, by 1 month. Okay, so this is first order differencing. Then again, you will check whether it is stationary or not. If it still shows it is non-stationary, then again you have to go for a second order differentiation. But that means again you have to leave 2 space from the starting In this case, you can see you have lost one data. The first year data you lost because you have to go for differencing. If you go for second order differencing, you have to go 2 steps down, 2 month or year you have to leave, and again take the differentiation. If you know little bit of maths and all, you can understand this. So in this case, again some data you have to go away. In this case, 2 more data and 2 down also. You are leaving 4 data will be out. So the maximum differencing will stationarize the data, will make the data stationary, but you cannot differ. It is not good to differentiate between first and second order, because in that case you are losing the data very fast. Okay, sometimes you will see that data will become stationary by simply taking a log transformation. In that case, we say that the data is stationary at level only. For example, you can see, suppose your data is y is equal to x square. If you simply take the log of this, log y, then by formula you know your 2, it becomes 2 log x. That means it becomes a stationary data. So either you can make your data stationary by taking simply a log transformation, or you have to take the difference of the data, and maximum permissible limit is up to the second order differentiation, because if you do further, your data you are losing out data very fast. These are some examples of non-stationary data also you can see here. In this case, first case, you see here very high variance is there. Your variance is not constant. You see the diagram. It is not constant variance. Okay, and see the last data here, covariance is not constant because the distance between the peaks from one to the other is different. The third data, middle one, if you see, your variance and covariance is constant, but what you see is a trend. These are all example of your non-stationary data. So when they exhibit this, you have to make it stationary by either taking a log transformation, or you have to go for your differencing the data, first and second order. So this is about the integration part. So your I refers to, the I in the arima refers to how many differentiation you have taken to make your data stationary. If first order, then your integration part is 1. If second order, your integration part become 2. Third, beyond 2, it is not recommended. Another important part of your data is autocorrelation. Autocorrelation, if your data is correlated with your past years, that will create a problem. So we have to identify the autocorrelation. That means autocorrelation. That means the values correlated with its past year values. Okay, so that we can identify and remove. Okay, and we can do it with your SCF and PSCF test in the EVUs, which is your autocorrelation function and your partial autocorrelation function. Now, leaving this, some other important terms you see. One was autocorrelation. Another is white noise. Very often you hear of this term white noise in the time series data. So what is white noise? It is if the variables are independent and identically distributed with the mean 0. That means there is no seasonality or trend, then it is the white noise. And this is apt for your forecasting. So this is what is termed as the white noise of your time series data, which is good for your forecasting. So this is an example of a white noise data. You can see it's a straight, no trend is there. You can, it's a very random data and you can forecast it. No seasonality is there. So this is a very white noise random data and this is good for your forecasting. And if you are using how you are going to detect whether your data is white noise or not, what you are going to do is simply apply the SCF test. And you see the SCF test, which we will also do now, it will come within this bound. And if all your spikes are within this bound, that means your data is a white noise and there is no autocorrelation. Okay, so this can be done with your SCF test. Then this random walk for the time being will omit it, simply because this is something, random walk means where your current year values is, data is so much random that you find that you can see this equation here. Your current year values can only be predicted with one single past year values. You cannot take any other further lag. The data exhibits such properties. So this is what is termed as a random walk, very much compared to a very drunkard person. So you don't know which way it will go. We call it a random walk. And if it has a trend with it, along with random walk, it has a trend with it, we call it random walk with a drift. Either an upward drift, that means after a year of prediction, it can go up, go down. We call it a random walk with the drift. Okay. This is some other terms which is used in your time series data. Now this is a comparison. You can see white noise and random walk. So this is upper one is an example of a white noise series already we have seen, and down one is a random walk series. Where so much random so that you cannot rely on the past data. You use simply the 1 year lag data to predict or forecast about what is going to happen up to the current data. So moving on, seasonality and trend in time series data is making it non-stationary. We have to remove it. How we are going to do it? So you have to detect the stationarity of the data. First is visual plotting. Other is you perform the ADF test, which is known as your unit root test. Many other tests like Phillips, Perron and all are there to find unit root test. Unit root means your data shows non-stationarity. One very popular test is the augmented Fuller test. So moving on, this differencing part already I have shown you. Let us go to how we are going to find this ARIMA PDQ values, parameters. Now, when you are using a particular model, we write it in this format, ARIMA PDQ. ARIMA autoregressive, P means how many lag beyond you have used. Say for only 1 year, 2 years, that will be determine the P value. 2 years back data, remember the P element, how many years back, 3 years back data, 4 years back data, that you can detect from your SCF and PSCF function. D is how many times you have difference the data, 1 or 2 times, because I said beyond 2 second order differencing, you should not do, otherwise you lose the data. So D is that value. How many times you have difference the data so that you get a stationary data. You have removed all the seasonality and cyclical components and trend. And Q is about the moving average. That means where how many years back your error terms. After removing all these components, what is left is random error. So this error may also be correlated with its past values. So how many times lag past values error is correlated with? This is your Q element in your ARIMA modeling. So let us see a moving average model where you sometimes you just you can regress it the YT values against the error terms. Okay, so this is what is termed as the moving average model. So in this case, you can see YT is a function of the past errors. So ET is the error in first one, then this is a year 1 lakh back, 1 lakh 2. This is a moving average model where simply what you are doing is you are regressing your current year dependent values to the past year error terms, which is the error remaining after you have subtracted all the explained variables. Okay, so moving on, this is the ARIMA model where you have combined the auto-regressive part and the moving average part. So you can see the first part is the auto-regressive equation I had shown you, and the other part is the moving average part. Okay, so suppose for example in this model 1, 2 up to P may be 3, 4. How many years lag data you have used to estimate YT values, and your ET part shows how many year terms back you have used the error terms values, because your errors are correlated with this past year errors. Okay, now how you are going to build this ARIMA model? First is in reviews. Now we'll take a particular data like your FDI data and all. In this case, I have worked out the whole with your foreign exchange reserve data. So first we'll import the data, check for stationarity. If the data is stationary at level, we can go on proceeding, finding the forecast and all, estimating the equation, parameters and forecasting. If the data is non-stationary, which every time series data is, it's the nature of the 9 time series data, then we have to make it stationary after visualizing and detecting the data by how many lags we can take. Then you estimate the parameters, and then to find the fit of the model, we have to do some diagnostic test as well with the residuals. Okay, so let us see how we do it. So first is you have to perform the SCF and the PSCF test on the data. This will help you in identifying the P and Q component, because D is already when you have used the data for differentiation to find the lag after which it is becoming stationary, it will be detected. P and Q will be detected by the SCF and the PSCF function. So let us go to how it is being done. So these are some of the available softwares which you can use for time series analysis. The Python are very common in social science. We use the Strata. You use your SPSS Excel, but higher order calculation you cannot do with your Excel and SPSS. If you use Strata, these are the one you use. Now let us go hands-on session instead of wasting your time. So let us see how it is being done so that you can practice this yourself. So here I have taken the foreign exchange reserve data of India, okay, and we'll be using it to forecast in the EViews. So when you open the EViews, you will see this first screen comes, okay. So you just close it. From here, go to File, import the data. You have the import option. You import the Excel file wherever you have kept. Okay, so first time you import, then you can change your name and then you can save it for your further work in the EViews only. But for the first time, you can easily import the Excel data wherever you have kept it in your laptop. Okay, then there you see this screen comes up. Here in the description, you type time series. You are telling your EViews that is the time series data. In the description, you write time series. And at the lower point, you can see there is a check box which is telling you that rows, read by rows or columns. So if you have taken the data in terms of rows horizontally, in that case you can specify check this box. Otherwise, you can see my data here. I have copied the data, I imported the data. It is column wise, so I need not check this box. I leave it like that. Okay. So moving on. So time specification, this is the next screen which will open up. Okay, by default you will see it will be shown dated by series, and here it will come annual, and because our data is the annual data, we leave it in that default one. If you have taken monthly data or any hourly data, you have to change it by date and all. So here, because our data is annual, so I leave it unchanged here. This is the next screen which will open up in the EViews. Then this will come. This shows that it is importing the data. You click yes. So link the imported data. You will click yes. So clicking on, let us now visualize the data. To visualize the data, I have written all the command here. If time permits, I'll go through, I'll open the EViews and rerun all this thing in EViews only. I'm just showing you, the PPT will be there. You can just run it by yourself also. So first is, you can see, we'll go to quick, then graph. Okay, then it will show you the data which you have imported. Okay, in this case, we have the FER data. You click OK. So you see this dialog box will open. So under graph, you will use the line and symbol option to see if our data is non-stationary or not. So you see here, this is the plot of the FER data we have brought. It is non-stationary because you can see there is a trend here. It's going up. So this is a clearly non-stationary data. This is a graphical visualization. To further support it, the data is non-stationary. We are performing the ADF test, which is the augmented Dickey Fuller test, and you can see the values here. So how you can perform the augmented Dickey Fuller test? You will simply go to your series statistics. Then there you have this ADF test. You will choose. Now you see the data, the probability. Your probability is 1, which means more than your 0.05. You remember your null hypothesis for the ADF test is it has a unit root. Unit root means it's non-stationary. Okay. So now when you have a p-value which is more than 0.05, it means you are not able to reject this null hypothesis. That means the data is non-stationary. Of course, we have already visualized it. And this is further, the data is non-stationary because it has a trend here. So it is further being supported by this ADF test, which shows that the data is non-stationary because you have a probability value which is more than 0.05. Now I have differenced the data. I have taken the first difference. Plot of the first difference is shown here. You can see after the first differencing, you can see the trend has gone. Okay, so after visualizing the data that the trend has gone, I have reperformed the ADF test. Sometimes visualization may be incorrect, but your ADF test shows that you can see the probability value. I have second times I have run the ADF test on the first differenced FER value, and I saw that it is again more than 0.05. That means your data is still non-stationary. Okay, so now I have to go for a second differentiation. So I have to difference the data again. Again, I have difference the data. So you can see my variable, it is DDFER. That means this was the first difference, again the second difference. If you do it, the differencing in the EBUs, it will take a variable values like this. So this is the naming I have used. DD means difference of the differenced FER. So double differentiation I have done. So you can see now, this is the plot of the second difference. Okay, now when I have checked it with the ADF test, I got a value which is 0011. So now this is less than 0.5. Now my data has become stationary. I can use it for further analysis. So my data here is stationary after second order differentiation. That means, remember, in the ARIMA your I value becomes 2 because my data becomes stationary after the second order differentiation. So I have detected the I component in your ARIMA. Moving on. So this is the value of the second ADF test for the second differenced series. Already you have seen it in the plot. I have shown it here. You see the probability value 0011, which is less than 0.05. That means you now reject the null hypothesis. Your null hypothesis is the second differenced FER value has a unit root. That means it is non-stationary. Now this is rejected. That means my data has become stationary. I can use it for further analysis. Now I'm going to find the AR lag and the MA lag. How many lag period in the AR should be there and how many lag period in the moving average should be there. The other two component of your ARIMA. I have detected through the ADF test and visualization. So coming to your other parameters, I have used the SCF and PSCF test. Now with the SCF and PSCF test, you see this will be the parallelogram you will get. Now this, you see first the SCF test, autocorrelation, you can see in the screen, the spikes which are there, it is showing that it is highly correlated with that data in the past. For example, my this year data is correlated with its lag value in the first year, second year, third year, fourth year, fifth year, sixth year, seventh year and eighth year. From the eighth year, you see the line spikes are within the confidence interval, which are these dotted lines. Your spikes should be within the dotted lines to show that there is no autocorrelation. But all the data in the autocorrelation have moved beyond. That means your moving average, this autocorrelation is the indicator of your moving average period. Okay, so your autocorrelation moving average has a lag correlation with 8 years back errors. Then coming to partial autocorrelation, this will detect your AR values. AR, how many years back data you will take. In this case, you see there is only one spike for the first year. So your AR is related to autocorrelated with your 1 year lag values. So YT minus 1 only. Okay, so this has detected the AR and MA values. I was already detected. So now I have performed the same test on the your stationary data. Now in the stationary data, you see after the data has been stationary using the second order difference, this is the result. This was on raw data, the previous one. So after taking the difference and making my data stationary, I have used the SCF and PSCF test, and you see there is only one spike on the difference data. So my AR values is also 1 and my MA value is also 1. So you can take one lag period for both your AR values and your moving average value on my stationary data. After the second order difference we have done. So this is the interpretation. Remember, the SCF plot shows spikes at the first few lags. Then the moving average is detected by the, your SCF lags. So this, well, let us move on. Now I have estimated the equation of the ARIMA model. After estimating the equation, these are my values. I have used the AR and MA 1. Okay. So how we are going to do it in EViews will continue. Just let me show you the values. So now these are the parameters I have used in the equation. I have regressed my YT, that means my FER values, which is your foreign exchange reserve values, with 1 year lag foreign exchange reserve values, as well as your MA lag by, that means error lag by 1 year values, according to the your SCF and PSCF test. And now these are my coefficients I have got. You see the probability in the last column. You see the constant is significant. It is less than 0.05. So your constant term is significant. AR1, it is not significant. It is more than 0.05. But my other variables, which is your moving average MA value, is significant. And the last year value, you see sigma square, it is also less than 0.5. This last